good day, everyone. I'm Adam Bendel. I'm the CEO of Tonic, and I'm going to make a few introductory remarks at the beginning, but I think one of my colleagues is going to tell us a little bit about the technical aspects of the call. Jess or Dario, are you going to do that, or is this all supposed to be self-explanatory from the slide that's on the webinar?
Sure, happy to comment on it. So this webinar is being recorded, and we're going to share this on the Tonic webpage. This is going to support the Tonic T100 and public education activities. So we just wanted to inform you about that. Also, regarding questions, so all attendees are automatically muted. If you're calling via phone and you're only dialing in via phone, you will be muted for the entire call. And that means that you also cannot access the chat box. While if you're logged in Zoom, you have two options to ask questions. You can either use the chat box, and you can find that in the upper left corner of your screen. Second option is to raise your hand. You can also find that option in the upper left corner. When you raise your hand, we will wait for your turn, and we will promote you to speaker, so you can actually ask your question by unmuting yourself. So that's all the technical aspect. Something else, on the right side, you have the camera and you have the active view of the speaker. You can decide whether you want to keep just the one small box with the speaker video, and that's the one square box, or you can choose to have 4 thumbnails, and that's the other box with 4 little squares. If you click on the right side of your screen, you should see the cameras where you can manage that. And these are all technical aspects.
Great. Thanks, Dario. So Jess, push us along to the next slide. So a quick overview of our agenda this morning. We've got a lot to pack in, this afternoon or wherever you are, but right now. So we're going to push along briskly to cover what I think will be quite a wide tour of some of the pressing issues that we're all facing. So, as I said, I'm Adam Bendel. I joined Tonic in the leadership position last year, mainly to have greater impact in my own life and my professional life, but I have been and remain a personal impact investor for some years, and so just like all of you, I am facing these same issues of impact management and measurement that you are. My own experience has been that it is a lot easier for me to kind of intuitively assess the potential impact of an investment that I'm considering up front, and a lot harder for me to assess whether it's meeting my impact expectations as I hold the investment. And I know from talking with many of you and from our research work that I'm not alone. To give you a sense of that, next slide, Jess, please. The T100 Report, which we released in December last year, is a study of more than 50 portfolios of Tonic members who have committed to move that portfolio to 100% impact. And it talks about their journey in doing so from a qualitative perspective, and it also provides a number of quantitative assessments, ways of slicing the data depending upon the different type of investor and so forth. Sorry, go back just for a sec. So one of the things that we were able to do is to aggregate these portfolios and then assess across the whole of these highly impactful portfolios what their asset class allocations are. And that's what you see here on this slide, which indicates, as you will see, that public equities represent the largest asset class across these portfolios. Now that in a traditional investment portfolio may not be so surprising. It's a little more surprising with respect to highly impact-oriented investors, where public equities have been a difficult place to play. If you are very focused on the impact that you are seeking, then many of us have found public equities to be sort of tricky waters. And so we intend at Tonic to go through all of these asset classes and investigate impact measurement and management best practices, but we're starting with public equities because it's got such a large allocation. You also will see from the T100 report, which is available on our website at tonic.com/T100, that asset allocations vary by entity type. So the foundations in our sample actually have the highest allocation to public equities, followed by family offices and then individuals. And we can speculate, and we'll be doing more research to verify why that might be the case. But it's clearly the case across all of the entity types that public equities have a key role to play. So hence our kicking off this series focused on public equities. One other resource that we have made publicly available for the first time is the Tonic Directory. That is also available on the tonic.com/T100 landing page. And that directory contains all of the investments in the portfolios that were part of the T100 launch report. So that's more than 1,000 investments from Tonic members available to the public to see what kinds of investments people making highly impactful portfolios choose across asset classes, including in public equity. So if you're interested in seeing some of those examples, then please do take a look at the Tonic Directory. And then just finally, to make the point about kind of why the focus on managing and measuring impact. We talk about managing because, and not just measuring, because before you know what to measure, you need to know, before you know how to measure, you need to know what you're going to measure. And what we measure has a significant impact, we all know, on what people pay attention to. And so picking the right things to measure is really important. And then the thorny issue of figuring out how do I compare impact when I am sequestering carbon versus impact when I am helping maternal health in a developing country. Very difficult. It may be that the holy grail of a single impact number is not actually what we should be shooting for. That's what we're going to be exploring together in our Tonic series here. But we clearly need to identify what are the appropriate dimensions. And we've got a number of great panelists who are going to talk to us today about how they're thinking about this. So with that, I will turn it over to Paul, who will serve as our moderator.
Thank you, Adam, and thank you for your insight and for the T100 report. When I saw the webinar coming out, I just thought, gosh, they're brave. They're going to go after public equities first out, which we see at Panapor and at Snowball as the final frontier, really. So now it makes a lot more sense. I can see, obviously, that public equities are the #1 asset class for the impact investors that you've surveyed. So that makes a lot of sense. I did a little bit of research prior to the call. Don't quote me on this, but according to some website I found, the 60 major stock exchanges in this world have a collective asset value of $69 trillion. Now, I haven't got a clue what $69 trillion is. I mean, it just blows my mind. But I know the US owes about 20 trillion, and that's considered a very large amount of money. So clearly, 3.5-fold are held in public equities globally. And if it's anywhere near that amount, then it's very, very important that we engage in public equity in terms of impact investing, because it has a huge impact. And I'm sure the speakers will talk to that. So I applaud Tonic for their bravery and for getting us together to talk about this subject. I don't anticipate that we're going to have too many answers, but I think it's important that we engage. So we have today a panel where we're going to have a couple of investor stories. We're then going to talk a little bit about, and that's going to be Bruce and Kristen. Then we're going to talk Will's going to talk a bit about some of the tools you might use in order to understand impact in the space. And then Brent and will talk about some approaches that professional advisors take to managing impact. And then we'll turn it over to yourselves to have a bit of a Q&A and discussion. And then I will try to somehow summarize what has been said and some of the thoughts that we have. Before I hand over, just to highlight some of the things that came through, some of the comments that came into Tonic and the responses to some survey work. In terms of the tools that the audience are using to measure impact, they're using online tools and products such as OpenInvest, Sustainalytics, CSR Hub, IWF Social Score through Aperio, and the RS metrics. They're doing proxy voting and engagement through fund managers, and they're doing ESG scoring and using a carbon audit. Some of the challenges our members face are trusting the metrics. Often an advisor just doesn't offer a service in this area. They don't have the time to do it themselves. There are no common metrics. There's little clarity on which ones one should use. Often the investments and the advice is too light on impact. ESG scoring is limited. And sometimes if you actually do the diligence and audit things and drill down, you're really underwhelmed by what you find. One quote was that a company switching to email from paper was proof that a bank was going green. They thought that was a bit ridiculous in this age. And there's a whole bunch of questions that have come through in advance, which we will try to get to in the Q&A. Before I turn over to our august panel, just some reflections on our journey at Panapore and at Snowball. And before I say anything, my lawyers get extremely nervous whenever I speak in public at all, particularly when I talk to my American cousins. So just so you're entirely clear, everyone on this call, and apparently it's going to be recorded in public, so I'm even a little bit more nervous. I'm not promoting anything. I'm just sharing some thoughts. So at Panapore, we decided we're 100% impact charity with all of our corpus, and somewhat inspired by KL Felicitas, we decided to invest across asset classes in impact. And we have engaged with public equities, and we see this as the final frontier. It's the most difficult area. And we put out an RFP. We researched the market, drew up a long list, put out a request for proposal from a number of managers and providers and wealth management people. And we were quite surprised that actually people responded. And we held a tender board and invited a bunch of others to join us in that. It's really been an interesting process. We haven't got to where we want to get to, but we believe in that you learn most by doing. And so we're engaging and we're working with partners to work with them to help them to be as good as they can be and to meet our needs. And then as part of this journey, we've actually engaged with another foundation called the Golden Bottle Trust and decided that we're going to tip our assets into a limited liability partnership together to try and grow a partnership, again with a view, and with a view to investing across all asset classes. And we debated long and hard about the public equity side, and we knew how difficult it was, but we thought there's no way we can do this without engaging in that area. And the final goal is to launch something in the London market so that retail investors can get involved. And again, we think the public equity part is really, really important for that. So hopefully that's helpful in terms of setting the context for today's discussion and for a little bit about what we've been up to. And I would like to turn over to Bruce now. Bruce, would you like to share some of your experiences?
Sure, absolutely. Next slide, Jessica, thanks. So my name is Bruce Campbell. My day job is working as a lawyer in the impact investing field. I actually spend most of my time working with impact investors and helping them with the legal work around their investments. And as a firm, I manage a small boutique firm focused on working with impact investors, social enterprises, and tax-exempt entities. So I was inspired actually by my clients and working with clients who'd adopted an all-in 100% approach to impact investing to explore that kind of investing with my own portfolio It took me a couple of years, I think, because I initially had this this idea that impact investing was really something for people. Didn't think this was something that was available to me, but it became really important for me to kind of live out my values and live out these principles in my own investing. And so I've started this journey over the last few years of how do I, with a relatively modest portfolio, become an 100% impact investor. And in the public equities, I have probably a relatively small amount of public equities, relative to what Adam was showing on his chart. I have a lot of my net worth still locked up in my business and in some real estate assets. But in the public equities realm, it has been very important to me that I be able to find investments in the public realm where the impact of the investment is being measured and is being reported on. And for me, it's critical because I'm much more someone who's approaching this from the idea that what's most important to me is impact. I have a sense that financially I'm going to do fine and that I will have enough. And what's really important to me is the impact piece and feeling like I'm investing with integrity. Next slide, thanks. So I have my approach with respect to my public equities. Most of that I'm looking at a very long time horizon, 20 or 30 years, and I'm really thinking about what is the next economy look like, the sustainable economy that we're all hoping for in the future. And so I'm investing in the kind of companies that I think will be relevant and will be helping to build and sustain that kind of sustainable economy. So I'm looking at things like renewables, resource efficiency, medical, and good tech. Next slide, please. So in terms of what I've tried, I have tried looking for mutual funds. I mean, most investors with sort of the assets I have available for public equities would be investing in mutual funds and ETFs. The problem is that other than one bond fund, I have not been able to find mutual funds that report comprehensively on impact. I see a lot of SRI funds now changing their names to impact funds, but they haven't changed their approach at all, which is they will do a positive screen, which is great. They'll report on some success stories, but they're not comprehensively reporting on impact. And and without the comprehensive reporting on impact, not only do I not know what's happening with my money, but it's also impossible to assess managers' performance. So I can't tell, is Calvert doing better with their impact approach than Domini? Working with wealth advisors, the problem I've had here is that at least the wealth advisors I've talked to with my asset base, they don't really want to get into stock picking. They want to put me in mutual funds. And again, the problem I identify with mutual funds, even with managed accounts, at some of these bigger banks that have an impact managed account, those managers also do not report on impact. So I've been left with really picking my own stocks. I have been impressed at the kind of data that's out there, that's available once I started digging into it. In fact, and I found looking at some of the social responsibility reports of these various companies, I've really been inspired by what I found, especially in Europe. I often wish that I worked and was paid in euros instead of dollars because I just am much more inspired generally by what I see in Europe. And
believe you me, you're better in dollars than you are sterling these days.
Well, yeah. And as an example of that, just to give you an example of a recent investment I made. Next slide, please, Jessica. And again, this is Siemens. I invested in them primarily for the work they're doing in resource efficiency and renewables. And I can see, from their report, they have a very, very comprehensive reporting that they do on impact. And here's just some very simple data, for example, that they provide around the sort of impact that their renewable practice is having in terms of carbon emission reduction. Next slide, please. So you know, the problems with picking my own stocks probably obvious to a lot of you. One is that, you know, the research that's available to me is relatively shallow. I do the best I can, and I have a fair degree of confidence around the decisions I'm making, but certainly don't have the kind of information to me that a professional analyst would. And really the bigger problem is bandwidth. I have a full-time job. I'm really passionate about what I'm doing in my own investing, but it's very, very hard to keep up with it. Next slide, please. So I think about what I would want. You know, ideal for me would be some of these public managers that are out there that are committed to having an impact strategy in terms of they're doing a positive screen on the front end. I'd like to see those managers doing some measuring and reporting on their impact. And if that costs more, then sort of have the courage to charge more. See if the market will, see if you can convince the market that I'm charging more, but I'm actually providing more value. And if the market really won't sustain that increase in fees, if that's really required to do the measurement reporting, then look around for subsidies. I mean, I know certainly in the private realm, you have private funds that sometimes are able to raise grant capital to help with some of their impact related activities in terms of measurement and reporting. And so why not do that in the public sphere? That's it. Thanks, everyone.
Thank you very much, Bruce, and completely echoes sort of my experience. Is quite interesting in the work that we did when we did the tender board. I went to a wealth manager and I said, there's a chunk of money. I want the most impactful public equity portfolio you can possibly deliver. I don't want you to beat the market. I just want market rate returns. I want market rate returns, excuse the buzzword, with impact alpha. Go for it. Just blow me away with the fantastic impact stories. And then I said, look, that's really pretty much all we're going to ask you about. Okay. I'm not going to talk about Sharpe ratios. I'm not going to, worry about volatility. I just want you to blow me away with impact. And it's as if they just don't believe you because what they came up with, I mean, a really good methodology, great guys. I've known them for quite a long time. And maybe it was just my lack of communication skills, but what they delivered, we just looked at it and went, why would we want to own that?
Yeah.
I mean, why do we, I don't want to, I want to be, and the challenge we said was, look, you can pick a name, which we will disagree with. That's completely fine. But you need to be able to vigorously defend why you want to hold that name. Yeah. And that was the challenge. And so many of them, we just pick a name. You're like, boof, why that name? And it was just like, well, it's a great stock and the vol's reason. No, not the question I'm asking, please, would you tell me from an impact perspective, why I want to hold that and why my trustees want to hold that? And they just couldn't answer the question. And it's almost as if they don't believe us. And so I absolutely, my experience mirrors yours. And I think all of us really need to continually challenge these people to say, believe me, I'll pay more. It's okay. I know that's weird for you, but it's okay. Thank you very much indeed.
Sure.
I would like now to pass to Kristen to share some of her experiences.
Hello, good morning, everybody, and good afternoon to those of you in Europe joining us today. So I actually got into this as an impact investor, and I was actually not in the public equities, having left in 2007, and then decided that I really wanted more people to play with me, and that meant being in something that was really accessible. And we love the public equities for their liquidity and the low entry. And so how could we make that as impactful as possible? And doing that, I was, again, already coming from my venture capital, my loans, and my awesome cash that was being so impactful. And so how could I bring that style of impact investing to the public markets? And can we actually go to the other slide first? When I started Nia Global Solutions, I developed 6 solution themes, and basically very similar to what Bruce was saying. What do we need for the next sustainable economy? What's going to be needed for our planet, for both the planet and our people to thrive? And so developed out 6 solution themes. And so as opposed to what other managers were doing is positive screens or negative screens, I really took that venture capital approach and said, this is what I'm looking for. I want the very best in clean energy technologies. And I want to know, as far as converters, as far as panels, who's being the most innovative and what is best in class for wind, solar, waves. Then affordable housing. That's actually really tricky to do in the public markets. And yet, if we could scale that, it would be a really amazing solution. And so, again, I'm not going to go through every single solution theme, but that's how we decided to do this. Organic foods, again, really picking things that were needed for people and planet, and then also knowing that our public equities are our largest companies, so by definition, they're our most impactful. And are they having the impact that we want to see? So we go towards these solutions as opposed to screening away anything else. We don't look at anything else. So, you know, we wouldn't be looking at fossil fuels or anything extractive. With healthcare, we're really looking at our tropical diseases. With climate change, that band is getting much wider. And so we're seeing tropical diseases really get out of control in some areas. We're also looking at our HIVs and our worst cancers and how can we solve for some of those. Similarly, financial services, how can we do those things? To do this all well, we're looking at, in addition to our solution themes, diversity and leadership. And so how can we have the most innovative teams? The tricky part then is how to measure our work. And so what we are doing is putting out a impact report every quarter. And we just pick a different theme each quarter and give people a bite-sized chunk of what it is we're doing and how the portfolio is being impactful. For example, last time we did sustainable transportation. Upcoming this time is gender and diversity. And then how are we measuring that? So we're looking at every different type of thing. And just to answer kind of what Bruce said, I don't want to see fees go up. I want to see transparency happening so that this information is much, much easier to get. So we do as much as we can in-house. This is a separately managed account. And so I do want it to become a mutual fund. Once we have enough assets under management, we can do that. Our current minimum is 100,000, and so it's not as accessible. Once we're that mutual fund, we'll then actually have much more access to some of the research as well, as far as what's happening within our companies. But just measuring that impact has probably been our one of our most fun things to work on, and it's also challenging, but yet I get on the phone with companies, HR, IR, trying to find out answers, looking every different report. And then I also meet with the employees and the C-suite, just doing a lot of qualitative data in addition to the quantitative data that we can get. And then finally, we partner with HIP, which is Human Impact and Profits, and they really help us because they're designed to do that. And so it's kind of for us a double check on our own work, and then also an outside perspective on what's happening. And so we can go to the next slide. Just one example of what they're doing and helping us. We are really focused on diversity and leadership, and yet you can measure women. Because it's a global portfolio, it's hard to say, for example, in Germany, what does diversity mean to them? Whereas we do know that companies there are really putting women in leadership, and so we can count that. And so that's where we are now as far as trying to measure diversity. We use women as a proxy for that. And this is a slide that they made just comparing, and S&P, the 1500 or the 500 isn't a benchmark for us, but that does have the small, medium, and large cap, and so they just picked that to show. What this slide doesn't show is all the different things that we're looking at to get to these numbers. So we're looking at, numbers of women in leadership, but we're also looking at number of employees. And then by design, Nia's looking at products and services. And so we have that gender lens woven throughout. So we're also looking at what kinds of products or services and how helpful are they to women. For example, let's see, what's a good one? Well, we have some that are working on some of women's cancer specifically. Some of that testing, we're also, our HIVs and our AIDS are really targeting a lot of women as well. in addition to, say, Square, that is helping, business owners and a really high rate of women get to market and get to be able to sell their goods. So what's behind all these numbers, I think, is what's the interesting part, is how we're measuring. And I just would say it's a complicated soup right now, and it is, we're using every piece of data from Bloomberg, to all of the, what's available online, in addition to some of these innovative, just, I guess I'd call it grassroots groundwork of how to get to some of this information. And then reporting it out in the quarterly reports. So I'll stop there because I know we'll have questions at the end.
Thank you very much, Kristen. And I think it's very interesting to see your approach. You described as a VC approach. I might describe as a private equity approach, but essentially finding a few names that you're really confident are going to have impact, getting to know them really, really well as an approach to public equity investing. And I think that's, for me anyway, the most compelling way to do this. I think it's challenging when you meet managers who have a universe of 10,000 stocks and then, they end up managing, several hundred. The idea that they're actually going to be able to get to know them well and really understand the impact at this stage in the evolution of impact public equity is unlikely. So I applaud you on your approach, and let's hope that maybe someone on the call can ping you $1 million, and then you can offer it to retail investors and others, and Bruce can pile in.
There you go, Paul. I just want to. Well, I want to thank you, but I also want to make sure that you and everyone know that, there isn't a perfect company. So even though we are investing in what I believe to be the very best of the best public equities out there, I really do believe that we are also advocating. So you can see these numbers, women and females in leadership, even of the very, very best companies. We're at the very minimum of what they could be doing. So we are actively advocating with all of our companies to telling them what we like. Could they keep doing that and more of it? And then could they, whether it's employment practices, even some of their green practices, we think that they're doing great. We want to push them to do even better.
Absolutely. And you mentioned pharma and healthcare, and that's quite a challenging area to find, companies that you can really, really want to own. But you probably find the best and work with them to make them better. It may be a good approach. Thank you very much. Will, we'd like to go to you now to tell us a little bit about tools, I believe.
That's great. Thank you. And hello, everybody. I'm glad to be here. Maybe we could forward a couple slides, skip the legal disclosure. There we go. Lisa originally asked me to talk a little bit about ESG integration and how that works in public equity in particular. And so I'm just going to give a little bit of an overview from my perspective and what I've learned at Selman. My role at Selman is the head of impact, and I help our clients understand the complexion of their portfolios beyond just the financial returns. So that's what I spend most of my time on. I think I have 5 minutes here, and I got just 3 slides, and I'm going to ask Doug Spencer to contribute on that last slide. So just very briefly, this slide here that you're looking at, I think distills some of the most key characteristics about the benefits and the disadvantages of relying on ESG, environmental, social, and governance data to construct investment portfolios. And in the red box in the middle, I think is the most salient point, which is that ESG and incorporating non-financial variables into investment decision-making really helps you understand how companies conduct themselves and how they're doing their business. That's very much different than what companies do. And I think as an investor, you can pick which one of those you like, and you can place some more primacy on the one that you think is best. But a good example of this is Nike, for example. They've really led the way since their sweatshop controversy in the 80s in reducing the toxicity of their production and taking care of their workers. So they're doing very well and get good marks on those kinds of considerations, but they're also producing shoes that last 300 years. So you got to decide if that's, which one of those is more important to you. Another one is Statoil, the Norwegian state-owned oil and production company, oil and gas production. They routinely get the best scores on ES and G dimensions all the time from all the different providers. And they are making some demonstrable impact along those lines. But again, it's an oil and gas exploration company. So you've got to decide which of those is really most important to you. One other thing I would just point out is that, the growing popularity of ESG for investors like the people who are on this call today and beyond is that companies are more and more aware that investors are looking at and scrutinizing this kind of information. And as a result, my optimistic side thinks that companies thus will be induced to improve their behavior. And many of them actually are in a number of different ways. If we look at the proliferation of CSR reporting, we can see it's just going up and to the right considerably over the last 10 years. And I think that's not because companies are nice people necessarily, it's because they know that that's appealing to a wider set of investors. And I think that's a good thing. The big challenge from my point of view about ESG integration is the reliance on ratings. There's a dozen or more different providers of ESG data and ratings, but oftentimes their methodology is very opaque, and even if it's very clear, you may not agree with how they render a score. So it's very important to understand what kinds of weightings and considerations they're giving to these kinds of things, so you can understand if it really is aligned with your aspirations as far as impact creation. At the bottom of the slide, I'll just move on. There we go. So I just wanted to say, as we integrate ESG, I think there's a continuum of lower impact to higher impact. It's not non-impact or 100% impact. It's different. And as you get more sophisticated with ESG integration, you can move away from the best in class, finding the best performers across industries, and you can get more laser-like and focus on positive screenings and finding companies with greater gender diversity on their boards or in their employees, for example. Let's move to the next slide. This is just a series and a summary of investment resources and some, just a drive-by of the plethora of resources out there, like Bruce had mentioned earlier. One of the things I think is very helpful with ESG is to go beyond just relying on the data that you're getting from an ESG provider or some online rating system and take a look at the actual companies in some of these portfolios. You can look at the constituents of ETFs these days that are so-called sustainable ETFs. You can also look at, I think, a useful resource is the Global Nice 100. They list the most sustainable companies. They help you understand exactly how they calculated those things. And it's just a useful way to compare some of the companies that you may see in your own portfolio and some of these third-party agencies who are rating those companies and really test the fit and how well that's working for you and whether or not that's delivering the kind of impact that you envisage for your portfolio. There's online a number of fee-based ESG reporting tools, and there's also institutional parties that deliver that data. We'll talk about that on the next slide, but one thing we'll talk about in a moment is CSR Hub. It's I've been making use of that for a number of years just because it's free, and that's a useful resource. There's some, I'm not totally clear on their methodology, and so I don't give it a whole bunch of weight. But the point is here, there's growing number of resources out there for investors to use in order to evaluate the ESG complexion of their portfolio. Last, there's other frameworks. The UN Sustainable Development Goals is a useful way to think about whether or not you want to align your resources with some of these global challenges and imperatives alongside other investors. And there's other frameworks out there. The Opportunity Index helps gauge the extent to which you might be advancing social equity or social justice. There's the Access to Medicines Index, which helps you understand how well a pharmaceutical company may be helping address some worldwide health challenges. Next slide, please. This is just an overview of data providers. I'll say this is highly abbreviated. As I said, there's at least 12 major providers out there, and there's a number of smaller ones. The issue really here is accessibility for retail investors. Most of these cost anywhere from expensive to very expensive. So it's difficult to get your hands on it. At Sonnen, we used MSCI. We think it's a nice complement between raw data and ratings. Bloomberg has a ubiquitous coverage, and they are really amplifying their effort in this space just because I think they see the writing on the wall that this is going to be a major opportunity in the market in the future. And Sustainalytics is another provider just like MSCI and Bloomberg. I was going to invite Doug to make a couple comments about CSR Hub because as I understand, he has been relying on that fairly heavily for his portfolio.
Thanks, Will. It's an imperfect science at best. trying to figure out what tools are useful or not. I mean, the way that I started out was kind of in public equity investing, was deciding what my themes are, like Kristen has done. And so my primary issues, equal pay, equal work, climate, carbon, sustainability, gender. And then I further tend to, in a public equity space, look at companies individually that are doing specific kinds of products or services that I happen to know about, that I'm kind of impressed with. And then I have questions around the types of investments that they're making. I may not like a company 100%, but if they're investing for the future in a way that makes a lot of sense for the kind of economy, as Bruce said, that we want to see 20 to 30 years down the road, I'm willing to sometimes vote with my dollars to support those kinds of investments. And I'll give you a simple example. For instance, Target, regardless of what you think about them, they have an internal goal of being the largest, the global leader in rayon reuse. They're going to be the largest clothing recycler the world has ever known. That's sort of a mission that they've got, and I think that's pretty cool and probably worth supporting. You may not like a lot of other stuff that they do, but their investment in that regard impresses me. I use, specifically to Will's question, really, I use two primary tools, Sustainalytics and CSR Hub. CSR Hub I like more because of the color that you can get by digging into the kinds of reports and information that they are accessing through their algorithms. They rely on a global data set that's publicly available if you want to look for it. So you can do individual company research. So I look at CSR Hub, I check the ratings, I cherry pick the top 20%, what they would consider their top 20% in a given area, in a given performance metric, and then I start digging into individual companies to see whether or not those companies are doing things in a way that A, justify the rating, and B, fits with my particular interests. Sustainalytics is kind of a first blush look. You know, it's a way to, I suppose, cut the wheat from the chaff, if you will, and at least get to, I use Sustainalytics to get to a pool of companies within the realm of my interest area to start doing some real digging. I fortunately do have the bandwidth. I've always been a stock picker. I like companies. I hate funds because I think funds generally are, I mean, passive funds are fine, but I really get frustrated with turnover and fees and costs and lack of information that they're able to provide, particularly when it comes to impact-focused kinds of things. So Sustainalytics is my first blush, then CSR Hub to do deeper dive on individual companies. And you can actually see their sources of information and read what they're reading. That's the basis for those ratings. So I find that pretty useful.
Thank you very much,
Sure.
Will, and thank you for sharing those experiences. Certainly, people often use those types of tools to filter down to a universe to pick from. Just a couple of comments. One is, you'll be a little bit careful though. Sorry to be negative about it, but Morningstar rated a bunch of ESG funds and dinged a few because of using their rating methodology. I don't know if you followed that story, but interestingly, one of the managers we're going to invest money with performed very, very poorly under the Morningstar ratings, which is pretty telling, I thought, given that we've done deep diligence on them. We're pretty convinced they're one of the best, if not the best, in the market. So that was quite interesting. Statoil is a really interesting example. I don't know if you've got any mates that work in that industry, but everybody wants to work on a Statoil platform. You know, it's where you want to be. You don't want to be working with BP in the North Sea. You want to be working with Statoil. And thank you for giving a plug to Social Stock Exchange. I appreciate that because we're an investor there, and they've got some interesting things. So thank you for that. Let's now move on to talk to the professionals about how they approach this for their clients.
Okay, I think everyone can hear me. I'm Brent Kessel. I'm the CEO of Abacus Wealth Partners and a co-founder of Align Impact. And it's probably important to share off the bat that both Align and Abacus are not money managers or stock pickers ourselves. We're advisors. And so the key is to find the right investment managers for a given client and their set of values and their risk return profile. So that informs kind of our impact measurement. And I'm going to show you sort of our framework for fund manager selection first. I'm going to talk a bit about shareholder engagement and how we report on that, because frankly, we think that divestment and investment are pretty blunt tools for changing behavior out there. It lets us all sleep better at night, but you don't change the cost of capital by divesting or investing generally. So engagement is the really sharp tool in public equities and unfortunately the least developed. As far as the resources that I like the most, IWF Workstation is a professional grade product, but really at a reasonable price, I think, and incredibly granular. I was just on there this morning looking at General Electric, how many Superfund sites they have, the last 10 years of their energy use, both gross and by $1 million of revenues. So for those of you who can afford $2,000 a quarter, it's an incredible tool for research, I think. On the free side, fossil-free funds, you enter your portfolio tickers and they will tell you your carbon footprint of your portfolio, your reserves ownership. And lastly, for those somewhat new to the space, I think the impact primer on public equity and impact investing is quite a good overview. So I don't want to spend a lot of time on this slide, but I want to give you a sense that this is kind of the framework that we use to evaluate public equities managers. And this happens to be one of our approved managers, the DFA US Sustainability Mutual Fund. But we have these on firms, you know, on strategies like Nia Global, on Sonen's public equity strategy, et cetera, so that we can figure out where different players sit in the market. Oops, sorry, I'm not sure. The control isn't going so well.
Could you go back up to the previous slide, please?
Yeah, I'm trying. The arrows have disappeared. Jess, you want to retake control? I just don't see the arrows today somehow. This particular slide, we look at the investment universe that the manager is investing in. Are they active or passive? What negative screens are they including in the case of a mutual fund? Or if it's a separate account manager, what negative screens can our client select from to divest? And is the basis for exclusion just an entire industry exclusion, or is it revenue thresholds or other things? What are the positive screens? What can you tilt towards, and how do you do that? Is it best in class or optimizing a certain score? What's their approach to shareholder engagement? Are they sponsoring resolutions or not? How do they vote proxies? Who are the data providers, et cetera, et cetera. So this is very high level. But when you're when you're tracking several hundred managers, this is kind of our starting point. Next slide. So I think I still have control of it. So anyway, impact reporting for us, because of this approach, our approach is generally to favor managers with very diversified, low tracking error market-wide portfolios, because a lot of our clients have fiduciary duties. They can't be in 20 stocks or 30 stocks. They might be in a ERISA retirement plan. They might be a trustee on a family trust. But we generally try to keep tracking error around 1.5% to the market benchmark. So there are hundreds of names in a separately managed account or thousands of names in a mutual fund account. So as a result, what we report on are portfolio-wide metrics on divestment, investment, and engagement. And then we cull out certain stories from that reporting for the client to see. Next slide, Jess. So here's an example just of a divest, one page of the divest reporting we would give a client out of probably 10 or 15 pages. And there are about 3 dozen different ESG screens that could be applied across these two managers anyway, DFA or Aperio, who's one of our approved separate account managers. And in this client's case, one of their divestments was the coal industry. We gave them a couple of examples of companies they're not invested in. Next slide, Jess. On the invest side, with Aperio, there's really 2 tools that they use. One is called Social Score. This data comes from IW Financial. So we've actually created a proprietary social score with them that is made up of these 9 categories down below. Each company is measured on these things like human rights violations, diversity in the workforce, their pollution footprint, et cetera. And they're measured against their industry peers. And the industry is graded on a curve. And then we essentially look at the market as a whole when we report to a client. And at the time of this report, which I think was December 31st, the market as a whole had a social score of about 53. This client's Aperio separately managed account had a score of about 80. Next slide. We give them some examples. I won't read these for time's sake, but you can review them on your handout as to why certain companies are getting high social scores. The second tool Aperio uses is the weighted average percentage of revenue from clean technology solutions, which basically means alternative energy, energy efficiency, green building, pollution prevention, and sustainable water. The market as a whole is just over 3% revenue from these 5 industries. The Aperio account for this client was at 10%. So it's something you can target. You can target 5, you can target any number you want here, really. Next slide. And then we give them an example of one such company, in this case, Schnitzer, who's a big metals recycler, falls under pollution prevention. Next slide. On the DFA mutual fund side, their way of doing invest is to favor companies that are, this goes back to Will's comment on the how, not the what. If you want to have very low tracking error, you have to own companies in every industry. And so the key is to own the companies who have very low carbon footprints, if carbon is one of the things you're screening for. So one metric of our reporting is how much lower are these managers and the clients' portfolios than the benchmarks. You can see roughly 80% domestically and 68% internationally. Next slide. And how you get there, like you have to own utilities if you want to have a market-wide portfolio. So the funds are gonna over tilt to a utility like PG&E, who's sourcing 27% of their energy from renewables versus a 7% national average. Next slide. So shareholder activism, this client owned Goldman Sachs through As You Sow. They pledged their shares for a resolution for more disclosure around Goldman's financing of the North Dakota pipeline. We'll share those kinds of resolution actions that have happened. We'll also share all the ESG proxies that the various managers in the account voted on and the names of the companies that the client owns that were voted on. If the client wants, we can drill in further as to exactly what the votes were. And final slide, please. So Lisa asked me to share my impact wish list. I think the 2 things are what I'd call one-click shareholder engagement. What if we could have a tool that, like change.org or Boycott, you signed up for a campaign, you said, I really care about not having child labor in the supply chain, and then you uploaded your portfolio and the tool said, well, hey, these 5 companies violate that campaign for you. Click here and you can see other companies with the same financial attributes you could replace those companies or managers with. And then a second button that sends an email to the head of CSR and the investor relations department saying, hey, by the way, Target, I invested in you because you're doing this around recycling, and I divested Walmart because of ABC, and perhaps ways to share with social media. Number 2, others have said already, but more transparency and standardization. How is each manager computing their scores? What are the data sources? Ideally, an industry standard grading rubric. So those are my thoughts.
Thank you very much. Love that click at a button voting idea. I think just to say to people listening in, it might be time to start typing in a few questions if you have, because we're coming towards the end of the sort of formal part. We're going to be going to the Q&A soon. But we'll pass to Will to share some of his experiences at Sonnen as a professional advising people how to do this. Thanks, Will.
Thanks. Great. Hello again. So I'm going to present some similar material that you just saw from Brent. First, just to explain our approach, we invest in public equity strategy, and we really rely on MSCI as our data provider. We complement that with third-party research and some of our own research, just to make sure that when we see a high rating or a low rating, we can corroborate that from a different source. We've also begun in the last year, since the UN Sustainable Development Agenda came out in late 2015, to test our alignment with that framework. And I'm going to walk through a little bit of that later. But we think, there's an explicit call to action for private asset owners to participate in the sustainability agenda. And we have an ability to test our alignment and that contribution. So we want to do that wherever it's possible. And then going back to a comment that Bruce made very early today, the impact reporting that we provide is part of our management fee. We are an impact investment advisor, and clients come to us because they want the financial returns, but they want the impact returns as well. So that's part of our value proposition, and I think we're seeing more and more of that come into the marketplace. Next slide, please. Just to walk you through a little bit of how we take a look at energy and carbon emissions. This is 3 different ways of characterizing in our global public equity strategy. We can look at the total carbon emissions on the left. We can look at intensity, which is a measure of how many units of carbon does it require to produce $1 of economic output, helps normalize across industries of different sort of companies of different sizes. And then on the right, you can see that we've compared 2 of the highest carbon intensity industries, marine transport and utilities, just to illustrate that you can, in fact, invest across different kinds of sectors and industries and pursue a low carbon profile in the meantime. Next slide is an initiative we're undertaking now about science-based targets. Basically, the idea here is that in order to avoid the 2-degree climate scenario by the year 2100, we know that we can only emit so much more carbon into the atmosphere. That's a scientific basis there. We also know by industry and by company how much each of those entities need to reduce their carbon emissions in order to be proportionate to that line. So now we can start to look at individual companies, we can look at a portfolio performance and say, are you reducing your emissions in a manner that is consistent with the global climate imperative? And so this is really about picking high performers and companies that are able to explain and illustrate their carbon emissions. Next slide, please. I'm going to go fast through this because there's a lot of material. We're a little bit behind. Again, I mentioned the Sustainable Development Goals in the agenda. There's 17 of them. And again, what I think is most exciting here is that unlike the Millennium Development Goals, there's an explicit invitation from the UN for private sector and private asset owners to be a part of the sustainability agenda, whereas the Millennium Development Goals were really about multilateral and bilateral development institutions carrying out their pursuit to pursue sustainability. Just to show you how we're thinking about this, if we go to the next slide, for each Sustainable Development Goal, the UN has articulated impact targets. That's on the far left of your slide. And just recently, a governing body also suggested a series of impact indicators which would help all of us understand how well we're contributing or not to those impact targets. From our perspective, those indicators are reasonably good, but they're insufficient to really capture the breadth and depth of what impact investors are already doing in this world, in this sector. So we have proposed a number of indicators that you can see on the right for this particular goal that we think would help explain our contribution to that particular Sustainable Development Goal. If you look at number 4 there, the rate of energy intensity improvement, that's an explicit impact indicator that the UN has suggested. If we go to the next slide, we can start looking at energy intensity across public equity portfolios and indices. Here we can see 2 things I would point out. First, the absolute number here between a global public equity strategy, this is Sonen's global strategy, versus the ACWI IMI, that's the All Country World Index, and the ACWI ESG Index. And first 2 things here is the absolute emissions are wildly different between the 3 different strategies. And the second thing we want to look at is the energy intensity and the rate of improvement or not. And here we're seeing both the indices are actually increasing. It's difficult to see on that slide perhaps, but there's a positive slope there, and that's the opposite of what we want to see. We want to see that line going down. Next slide, please. I have 2 more slides here, and one of the things that we've tried to help investors understand is that there's the typical indictment of public equity is that there is no impact. It's trading on the secondary market, and there's no way thus to express any additionality, which is kind of the benchmark for impact creation. And we think additionality is a nice notion, but we also think that there is tremendous impact in public equity markets, just like we heard very early from Paul about just the sheer scope and size. So we've come up with what we think are different dimensions of impact creation beyond additionality. Intentionality is what are the intentions of the investee or the investor to create positive change. Measurability is how well things can be measured and outputs can be evaluated. And scale is just the size and breadth and depth of operations. If we take a look at 2 otherwise very related investments in water, we can see a public equity infrastructure rehab company that's operating in North America, and we can contrast that to a drip irrigation technology in a private equity setting. If we go to the last slide here, this just contrasts how these different dimensions of impact creation are expressed through these different asset classes. If we take a look at additionality for public equity, it is low and it will always be low. It's just the intrinsic nature of that asset class. As I invest, it's not really going to change whether or not that public company is going to do more or less of its work. But in contrast, if we look at the additionality for a private equity, it's actually quite high. My invested dollar there might manifest in, or it might help underwrite the development of that technology and its rollout into wider markets. We can contrast that with scale. In this case, this public equity company is investing in operating in 3,300 municipalities in North America and increasing water efficiency by up to 40% in many of those cases. So that's an enormous scale and enormous positive impact for that particular asset or security. If we contrast that to private equity, we see scale here is expressed not very strongly, just because it's unless and until that technology is widely adopted and taken to scale, it's going to be operating in just at a much smaller amount than that public equity. This has been a useful tool for us to just help investors understand that different asset classes deliver impact in different ways, and it's important to understand that, and I think not to marginalize public equity and understand how it actually creates impact. Just to end on my wish list, I actually quite liked what you had to say. I like the one-click idea. That's a great one. What my two wishes are just greater access to non-financial data for retail investors. As Bruce mentioned, it's kind of a struggle to avail yourself of meaningful impact data without paying lots of dollars for it, because most customers for this data are institutional money managers. And then the second thing is just greater access to impact investment portfolios among retail investors. This is largely the domain of high net worth individuals and foundations and institutions. And I just have this vision that if you were able to elect how your IRA or your 401k were invested by your employer, there would be many, many more dollars flowing in this direction, because we know that that's where the millennials generation wants to go. And I think that would just harness a lot of the potential. So thank you very much.
Thank you. And it's not to big you guys up too much. It's always a pleasure to hear your thinking in this area. A number of comments have come in about that. In terms of the public markets, I used to live in San Francisco, and I remember almost crashing my car when I can't remember what some radio program announced that, and I'm kind of nerd who'd be interested in this, that Walmart had announced that they were going to ask their supply chain, as part of their getting onto the list of people, an approved supplier for Walmart, they were going to ask for the environmental policy for any supplier, from any supplier. No expectation as to what they would have to do, just their standard form. Please, could you tell us about your environmental policy? I remember thinking, wow, that is going to have a massive impact. And I think that hopefully illustrates your point that, you know, whether you like or loathe Walmart, the fact that they have that in there ripples through. The impact is massive. So yes, I think public equities is a place to play. So now this is the time for those listening on the call to ask questions. And hopefully the technology won't move against us. I understand that you're muted, but you can ask questions through the text box, which I will try to relay. But also there's a way of unmuting you, and I'm not in control of that. So
yes.
May,
I can explain that. So
okay.
On the upper left corner, you can see a little hand. You can actually click on it, and it's called Raise Your Hand. And okay. If I see that, I will promote the attendees to speakers so they can actually ask.
Okay, someone who has a sort of a name, Jay Belsky, has put their hand up. I don't know who that is, but that's a Mr. or Ms. Jay. Can we unmute Jay Belsky and ask them to ask their question?
See, connected. cannot see Jay connected. Actually, I see my call.
Okay, well, I will try another question.
I do see Jay, and I think I've just promoted him to speak. So I've unmuted. I know you should be able to tell him in now. Hi,
Jay, hello.
You're here. But I'm going to go ahead and mute you because I'm getting some feedback.
Ouch.
Sorry about that. Let's move on.
Hey, Paul, this is Lisa. Why don't we jump in on some of the questions that have already been put in? For instance, there's two in there for Will. So one's from Bruce Campbell and one is from
okay, I've got a question here about the Sustainable Development Goals. And the question is to Will, I think. The Sustainable Development Goals, like the Millennium Development Goals, focus on emerging markets, where the largest gaps in the target areas like education, healthcare, and poverty alleviation exist, with public markets in those countries often prohibitively expensive to access, or a small part of typical asset allocation. How is the use of Sustainable Development Goals as a measurement tool impacted? And that is for Will.
Yeah. Well, the truth is, much of the opportunity to create positive impact, particularly with the SDGs as they've been articulated, does exist in emerging markets. And I think the quick answer to your question is that if you're not invested in there through public equity or public markets, you may be making less of a contribution. However, many of the Sustainable Development Goals are also accessible through fixed income securities, real assets, private equity. We can seize those kinds of opportunities, which are abundant, actually. I also think that we shouldn't underestimate the contribution that the public equities market can play here. Our strategy, our global public equity strategy, is global in nature and does have an exposure to emerging markets. And that's where we think we're making a contribution, and that's where our aggregated data is rolled up. So it's not like it's not as if the contribution cannot be reported upon. It just has to be, in our case, aggregated up and rolled up into the portfolio.
Thank you. Certainly, we look for that. We look for managers who can access those markets. But it's a good question because being able to invest even in India and other places can be actually prohibitively expensive for small allocations. So it is definitely a challenge. It was a good question. We have a question from Josephine Corrine to Kristen. Do you publish the data from your grassroots research? If Kristen is still with us.
I'm still with you, yes. We haven't yet, and happy to start doing that, though, if that's of interest to people.
It sounds like it is. Another question for Kristen while we have you. Would be curious to understand the obstacles to NIA undertaking comprehensive impact reporting.
Yes, so we're doing as comprehensive, I think, as what's available right now. And I answered this to Bruce and to everybody that SASB is really helping with this as far as defining what is material for each of our industries. And so I think that pushing that is really going to help us push companies to disclose more. What is more, what do they need to disclose? Instead of us trying to peel back layers of onions and try to get that data, it'd be great if it were just all readily available. So it's really just transparency issues.
Hey, Kristen, this is Bruce. The one question I have on that is, so the approach that I've taken personally is I will not invest in a company if they don't offer reporting on social and environmental impacts. And so, for example, looking at your list, looking at organic foods, Hain would be sort of a logical choice for organic foods, but they don't report on their impact. And so I decided not to invest in it. And I mean, and I don't, maybe it's a coincidence, but now Haynes being investigated for their accounting purposes. And the same thing happened with when I was looking at solar investments. Was looking at Sun Edison originally, and they don't report on impact, and so I didn't invest in them, and now they're bankrupt. So I probably just got lucky, but I sometimes feel like there's a correlation between, you know, the kind of companies that I want to invest in and their financial performance, and also whether or not they're really, you know, measuring and thinking very carefully about the own impacts that they're having.
Yeah, so I don't know that they're as correlated as you found them to be. I do think, for example, we're doing some really small companies, and they're, you know, after the bottom line in a lot of cases, and they haven't built out their teams to do all that reporting, and yet by definition of their service and product, we know they're being impactful. So to put some money with them and then encourage them to report on more of the things that we want to see has been our approach, to really be advocates. We're not going to drop you know, a really awesome piece of the solution or piece of the puzzle because we don't have all the reporting, and yet we really do want it and push for it.
Thank you. There's a question that came in earlier, which I think is sort of broad but interesting. What are the measurements that one can trust? So I guess we can pass to Brent. Do you want to have a go at that, or anyone really?
Yeah, I mean, I think you really need to know the source. So it's, you know, what's tricky is a lot of the measurements are biased towards larger companies because they have the resources to do reporting. And, you know, so you lose the small cap effect, you lose a lot of companies that might actually be much more ready to change supply chain behavior and a lot more nimble, you know, to become more impactful with your engagement. So I think it is about understanding, you know, how a data provider is coming up with their score, which was on my wish list around transparency, and using something like the IW database or maybe some of the others folks have recommended to dig under the hood yourself and understand where the numbers came from.
Would anyone else like to pitch in on that? Okay, I have another question, quite specific. Would anyone like to talk about ETFs? Someone has a specific question about the German market. Are there any ETFs available in the German market, which you may not be able to respond to, but it's really a question for Will or Brent. Do you like any particular ETFs in this space, or is that just a bridge too far at this point?
Brent, I'll mention one, and then why don't you proceed? I don't know anything about whether or not ETFs are available in the German market. I suspect that they are. There's one ETF recently introduced by BlackRock. It's called the Impact Sustainability Fund, I believe. Ticker is MPCT. I think it's reasonably well constructed. I was inspired, again, per my wish list, to see something that's more available to retail investors. A collection of companies that are selected largely for where their revenues come from, whether or not they address things like water and climate change, social issues. So I think, you know, that's something worthy of taking a look at. And again, you can look at the constituents online and see if that's something that is aligned with your intentions.
Did you get a chance to look under the hood with that? Because early doors, I was quite excited by that as well, and I even mates at BlackRock didn't get to look under the hood. So I'm curious as to what actually is going on there.
I'm actually undertaking that analysis right now. We're thinking about comparing our portfolio with that, just because it's ostensibly an impact portfolio, but for some reason or another, I have some suspicion about giant institutional investors like BlackRock introducing these things. So we're going to have a look at that. And I think that's really so important, is to really kick the tires and look under the hood, as you say, and understand the real complexity.
Yeah, I mean, I met the lady who's based in London, and when we did our research, there's a point about transparency that Kristen mentioned. They didn't even make the long list, you know, because we just couldn't tell what was going on. And so sorry guys, you don't get on. And I think she was quite shocked to hear that. You know, I'd love to engage with you, but you know, if we can't even see what's going on, even to a vague degree, then you know, I can't spend the time. I'm not going to invite you to attend the board or you know, you need to help me here. And she was like, okay, good feedback, thanks very much. So we'll see if that goes further. Brent, I don't know if you would like to speak to that at all.
No, I was going to mention the exact same ETF. I don't know if
Okay.
Germany or not. You know, and one thing I want to say about large firms is that let's engage with them. That they may be big, but there are human beings who work there, and a lot of those human beings care too. Yeah. So let's challenge them and invite them into conversations like this one and make them better, because that's how we really change these issues.
Absolutely. At Panopore, we have one of our key things that we do is called engaging with emerging leaders, and that can be an individual, it can be a team, it can be somebody who's, you know, 18 or somebody who's 73, but it's often you find frustrated entrepreneurs within large organizations who literally almost come and cry on your shoulder and say, like, how am I going to make the change here? And if you find those people, you know, you need to love them and you need to help them, because that's, you know, we're on the outside, we can do so much, they're on the inside. And well, this is our belief at Panopore, if you can, you know, show them a little love and help them network and just support them, then they're going to be much more likely to make that change. So I think that's an excellent point. Okay, Craig, apologies if this is rather truncated. It's because I'm trying to manage the technology. The questions keep rolling in and I'm trying to read them. Some of them are a little bit long for my brain, I'm afraid. Okay. Getting a little bit.
Hey, Paul, do you mind? There was one other question I had. Sorry to be talking so much, but I was curious. I had a question for Will in terms of how they're able to do the kind of impact reporting they do, and why it seems to be so hard for public managers. Why are they able to do it and public managers aren't?
Yeah, Bruce, a good question. I think it's a matter of willingness. You know, Sonnen, when it was created 5 years ago, was created specifically for the impact investment market and to create solutions for impact investors such as yourself. And so we made the institutional decision to dedicate in-house resources specifically to that function. And I think that's why, you know, that's why the impact research is part of the investment research. It's integrated. And my job and I have 2 different colleagues who help me, is to just collect impact data and start reporting it out. And much of it's on our website. We're confused often with the nonprofit simply because we publish so much on the topic. But I do believe that we're just the first movers in this. And I think that with this growing appetite and more investors coming into this space expressing this interest, that we'll see more and more of that kind of offering just because the market is going to demand it.
I think you're right. I hope you're right. Thank you. We have a question coming in from Canada, which is great. I'm a dual citizen, so I'm pretty happy about that. So I believe this is Ms. Cohen from the InSpirit Foundation in Toronto. Question to the panel: have you seen impact measurement approaches that span the entire portfolio, both private and public asset classes? We're working on one approach at InSpirit that is applicable across asset classes, and I'm curious if this holistic approach to measurement is a common one for other impact investors. I think I might go to Kristen on that one. I mean, anyone can pitch in.
Sure. So it's so interesting because I think that looking at every different stage of the investment, and, you know, for some of our earlier private opportunities, when you go in, it might be the exact same deal, same management, same product or service, same impactful this, but going in early, your money can be so much more impactful. So I think it's going to be very, very nuanced how we do it. I also think, and we know this on this call, it's not just the money that's being impactful. So if we are measuring the impact of a portfolio, we need to look at, you know, not only where our cash is, but have we helped our local community banks, and have we brought other people there, and have we held our events there, as far as some of our early investments as well. are we not only the ones, putting our money there first, but are we bringing in our friends and our colleagues, and are we using our other areas of expertise in addition to our money, whether that's contacts or how to do a term sheet, or any of our other resources that we might bring. So it's going to be an interesting way to report out the impact and also how to measure it. Similarly, others on this call have mentioned that in the public equities, maybe it doesn't feel like the most high impact, and yet we are sending market signals when we are buying those companies. And yes, buying a stock is very much like buying a used car, in that the money doesn't go directly to, say, Tesla or Toyota for that Prius. And yet, do we want to see more Teslas and Prius on the road? Absolutely. Do we want to see even more public transportation and sharing economy? Absolutely. So measuring everything we're doing and then reporting out, it's going to be fun and nuanced and interesting.
Thank you. Perhaps I should go to, sorry, I'm just losing my place a little bit. Adam, I don't know if you want to talk to that about measuring across a portfolio. That might be a good question for you, if you're still with us.
I am still with, oops. Yeah, there we go. I am still with us. Amazing. So I think what Tonic has to contribute to that is to try to kind of collate best practices and share those among active impact investors, which is what we are. So this whole series is really intended to further the state of the art in that regard. Today we've been talking about public equities, whether those same tools apply to, for example, private equities. Almost certainly they don't, because obviously there's no way to, there's no Sustainalytics or MSCI for private investments yet. But whether the underlying metrics might be the same, or what matters in a particular impact theme, we think that it's pretty likely that it does. So we will be, we've just completed, and I put this in the chat, but since I'm on the mic now, I'll say it. We've just completed at Tonic a mapping of impact themes to sustainable development goals. That enables us to inherit some of the work of the UN in terms of impact metrics and apply them to very specific impact themes. And we will shortly be sharing that with our members, but also making the framework available publicly, because we really hope that others will find it useful. We've shared it with a number of people in the industry who do, and I think that could become a basis for mapping impact across asset classes.
Thank you very much. And thank you to all the panelists and all to all the listeners and people asking questions. Thank you to Tonic for making the technology hopefully work reasonably well. We're coming to the end of our time together. I will do my best to try to summarize what I think I've heard and I think we've heard. I think there's certainly a willingness amongst this community to dive into public equity. We think it's an important area. We don't think it's perfect in terms of its impact reporting. There are a number of challenges, but I think it's a worthwhile activity, and there are some success stories. Some of the things that have come out of the, should we say, the wish list, or the, not the requirements, but the sorts of things we're looking for. There's been a call for transparency. That's certainly, I certainly echo that. Boy, wouldn't it be great just to have a simple mutual fund where Granny could put like $1,000 in and have some confidence that it's going to do some good? That to me is the sort of, that's the stretch goal that certainly we're driving for, and that would be great. So people like me wouldn't have to work so hard, to be brutally honest with you. I think there's an interesting call to funders, actually. Clearly, there's some people doing really hard yards to make this work, this area work. And it'd be pretty helpful to them if people who wanted to fund this area of impact investing, would just give them a chunk of change. I mean, I think of most of what happens in the UK anyway, in the social investment market particularly, but also in the impact investment market, it gets going because somebody just comes along and says, you know what? There's 50 grand, go do it. And talk about impact, massive. You know, Panopores are relatively small. And I'm not talking about myself, I'm talking about my peers and colleagues. Panopore had a huge impact in the UK market, not because it was massive, but because it just was the first name on the sheet. You know what? Social impact bond, done. We're in. I don't know what, 100 grand, 50 grand, we're in. And boy, did that have a big impact. And some of the people we funded or we granted money to, 10 years ago, 5 years ago, are now quite well established. And that 20 grand or 50 grand made an enormous difference at that time. So I would just encourage people to get involved in that way. We've talked about the greater access for retail, and both in terms of products, in terms of information. We've talked about the idea of one-click engagement. I think engagement is an interesting area and can have big impact. Share Action in the UK do some interesting work there and help you basically go to AGMs, help you write to people, to chief executives and so on, which is an interesting thing to do. And one of the challenges, I think, in the UK anyway, it's opportunity. People sort of rail against public companies, and I usually say, well, you own them. And they say, what do you mean I own them? They rail against, pick a corporate, they rail against them. I say, well, you own them. What do you mean you own them? I own them. Well, you do. You've got a pension fund. And normally in the UK, there's something like 27 million pension fund holders now because of auto enrollment. Pretty much everybody owns those companies. And then because they own them, they have the ability to engage. So I think there is a huge opportunity there in terms of public engagement. So I think that's an innovative and interesting idea. Again, if somebody wants to fund it, that would be great. Other specific parts of the wish list, we have, I think it's an interesting area in the idea that we're willing to pay more for this type of active impact public equities, to be as impactful as possible, to engage as much as possible, and we're willing to pay more. And I think perhaps the market doesn't trust that would succeed. And I believe it was Bruce said, if it's not going to succeed, if the market won't sustain it, well, then funders maybe could step in and help. Because I really, our thinking at Panopore anyway is that there's no shortage of capital to invest in impactful public equities and impact investments, no shortage of capital. And there's no shortage of great companies that need that capital, both in the private and the public sector. What's lacking, we describe as the plumbing that links one to the other. And sometimes that's a market failure that needs support. And maybe in this space, that's an area which could benefit from funding. I'll finish our time together. I think we've got 1 minute left to thank everybody, to thank Tonic, obviously, for setting this up, for the engagement, for the people who called in, and also clearly to highlight on your screen, again, great, as usual, great work from Tonic to give us a whole bunch of tools that we can access, and thank you for that research and that work. Without further ado, I will thank you for your time, and I will wish you a good day, a good morning, a good afternoon, a good evening. In the UK, it's 5:30, so we're still on tea rather than onto the harder stuff. But I hope you have a good day wherever you are. Thank you very much. Goodbye.
Thank you, Paul. I would just like to mention that you will be receiving an email with this deck with all the resource list. There is also a short survey, very quick. If you could take it, we would really appreciate that. And yes, and all the resource list. So thank you very much for joining the call.
Thank you. Thank you for making it all work. Take care. Bye-bye, everybody.